Greetings, salutations, and howdy to you all. I'm KT with Atocha Global Analytics. As always, I wish to remind you Atocha Global Analytics was created to provide insight and foresight into the street level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. So, welcome back to Forecast Friday. This is our once weekly segment, and this is the Friday, July 28th, 2023 edition. And away we go. So we have our standard tables today. We have some unique new metrics that we'll highlight this week, and a few noteworthy news items that we'll start with. And just to give you a little teaser here, it seems that we have two alternate universes operating. One is, economic decline, and the other thinks that the economy is doing too well and must be cooled off. So anyway, but first, the loudest news item is the Federal Reserve, of course, upped the Fed funds rate a quarter point. It's not a big move, but this flies in the face of a number of the early indicator canaries in the coal mine, so to speak. And these canaries are dying while they're raising the rates. So more on that during the review of our weekly tables. Second, we have a serious shift in the banking sector to highlight. During a video a couple days ago, I noted that there is a serious issue in the European banking sector, and you can see in this graph, their loan levels have simply collapsed. This is not due to regulatory changes, but due to independent lending standards increasing and a collapse in business activity. And this is also contagious. These issues are spreading. So please note that the current level shown on this graph is below the deepest trough of the Great Recession. And, so this is serious. Okay, third, and I'll interject this here to separate the two banking issues that I'm going to talk about. China is really struggling. 15 years ago, China struggling, wouldn't have been much of a concern because their GDP, their economy was much smaller, but their economy it was about 1/3 of the current percentage of world GDP back then as it is now. We happen to be 25% of global GDP. They are 18%. And the EU happens to be 16%, by the way. So the collective influence of the two dominant economic components in China and the EU, they total 34% of GDP, and both of them are in serious shape right now. So global trade, it's been way off. Domestic rail and freight traffic here in the U.S. are down. Imports have been soft. Matter of fact, GDP numbers noted that the imports had declined. And we have a bunch of leading indicators that are still flashing caution. And on top of that, the Conference Board, which is one of the most respected independent economic forecasting entities on the planet, they've quite recently forecast a recession to begin in the U.S. this quarter and proceed into the first quarter of 2024. There are just too many moving parts here. And they are all going in different directions, but we have to pay attention to this. And by the way, before I cover the fourth news item, please like, subscribe, and ring that bell to help us build our channel. Appreciate that. So fourth, the advanced release for Q2 2023 U.S. GDP was released this week, and the initial reading shows an increase of 2.4% on an annual basis. And my first response was, of course it did. Imports, by the way, which are negative for GDP, are way down as destocking continued. So that benefited GDP numbers. Imports were down more than exports, actually. So, that's part of the global slowdown revealing itself right there. In addition to that, government spending in Q2 jumped massively after the debt ceiling was uncapped on June 3rd. The Treasury surged and spending really elevated initially, creating an artificial and temporary boost to GDP. So, of course, that is a factor in that. And most of who follow my channel know that, the private sector components, usually with revised numbers, when you can really dig deep, they almost invariably end up being revised downward, even if the headline number is revised upward. So let's take it with a grain of salt. However, dig in a little bit deeper. Let's look at it. So the first quarter GDP was initially 1.1% in the advance estimate, then revised to 1.3%, and then finally revised to 2.0. 2.0 is somewhat low, but definitely not recessionary. It's still showing growth, and that's real GDP. Uh, However, here's a quote from the final revisions release. It says here, the increase in real GDP in the first quarter reflected increases in consumer spending, exports, state and local government spending, and I'll pause right there and make a comment of this. The state and local government specifically hired at a quite an elevated level from the norm, and that boosted employment numbers as well as boosting GDP numbers. So uh, otherwise, our employment would be much lower right now because private sector employment is not as significant as it seems to be reflected by just looking at the numbers. So, anyway, picking the quote back up, it says here also federal government spending. In the first quarter was noteworthy, and non residential fixed investment that were partly offset by decreases in private inventory investment. Again, that's part of destocking, and residential fixed investment. Imports increased, of course, which is a negative for GDP. So in the first quarter, that kind of held the GDP back. But anyway, so consumer spending was up. Okay, but so was all levels of government expenditures, exports, and spending on non-residential assets. Private inventory investment has been down throughout destocking, and it's running its course. It started last year and it's run right through this year. And residential fixed investments being soft. Well, with higher interest rates and a general plateau of the housing prices capping equity borrowing, that paints a clear picture where that's concerned. So, and lastly, imports, since they did increase, but they don't say how much. Imports, of course, being a drag on GDP numbers. So let's jump forward to the most recent advanced release for Q2 again. Here's a description they use to describe the drivers of GDP. The increase in real GDP reflected increases in consumer spending, non-residential fixed investment, state and local government spending, private inventory investment, and federal government spending that were partly offset by decreases in exports and residential fixed investment. Okay, imports, which are a subtraction in the calculation of GDP, decreased. So imports are going down, of course, because the rest of the world is slowing down. There was some private inventory investment, but it was primarily from domestic sources, which is a positive thing. But again, all they did was change the order of the drivers of GDP from one quarter to the next. They didn't really, nothing really substantially changed, and the only stated difference was that the imports decreased this time. So the fuel for any growth is basically the same. Now, last week, in this segment, I noted that GDI, which is an alternative measure of domestic production and output, that is supposed to be a valid alternative to GDP and has always tracked in conjunction with GDP, has diverged and has been negative 3 out of the last 4 quarters. That includes Q1, where it showed a nominal 0.56 gain or growth, but it declined 1.8% when adjusted for inflation. So that just shows you that the factors driving the GDP numbers are not private sector focused. We know that Q2 GDI, we won't know it for a couple months, but we can see the pattern. Government spending is what has been driving GDP. So anyway, well, we need to get to the fifth and final news item in this week's Forecast Friday. A quick aside that is not news, but I need to remind everyone that the lagging impact of monetary tightening or interest rate raises, it's supposed to be about 12 plus months. Usually they say about 16 to 18 months for it to really bake into the economy. Well, we're just now hitting the 16-month mark since the Fed started raising rates. So we should start feeling, or should be starting to feel anyway, the real effects right now. And the news is we're about to feel some serious headwinds from other factors right now when the real effects of these rate raises are finally beginning to hit us. So, the fifth item proper here is that Basel III capital requirements go into effect in the U.S. actually yesterday. Um, these regulatory standards for banks are going to restrict lending, and the expected impact on GDP is projected to be less than a 0.25% drag. But a 0.25% is a 0.25%, especially when it's been running a little bit slow. And of course, that's the going forward impact they expect. But the issue they don't mention is that banks are having to adjust their capital requirements to get to that threshold, which means offloading loans to comply because they're not going to be able to go out and get sufficient deposits just by the snap of their fingers. So now is not a good time to be offloading loans, by the way. So, and then in addition to that, now we have fresh regulatory proposals to have larger banks raise their capital requirements by as much as 19% under proposed U.S. rules. These new requirements they basically apply to lenders having a minimum of 100 billion in assets. So that widens the scope to certain regional banks as well, larger regional banks. Specifically stated in a recent Yahoo Finance reprinted article, I'll read this. It says here, the impact will differ from bank to bank, depending on their operations, which makes sense. Agency officials said the 8 largest banks that have huge trading desks and coast-to-coast franchises, such as JP Morgan Chase and Bank of America, they will see capital requirements rise by 19% on average. The smaller banks with 150 to 250, it's 100 million to 250 million, sorry, in assets, will see an average rise of about 5%. A number of mid-sized regional banks fall into this category. So that is going to really dampen lending when we've already had a lot of reasons to dampen lending. So this is my opinion on this. I sense that the goal of the Fed and U.S. regulators at this point is to kick the bejesus out of any and every kind of private business so the economy breaks hard. This has been kind of a multi-decadal pattern where government does the opposite of what they should be doing based on economic conditions. If economic conditions are weakening, that's when they decide to increase taxes or add regulation. The only rationales that really fit the pattern of actions is this. They either want it broken, they are simply indifferent to breaking it, or they are so oblivious to what is really happening that they're utterly clueless what the unintended consequences of their actions might actually be. Regardless, none of these news items are particularly good for economic growth in the second half of this year and into 2024. But I wanted to highlight that. By the way, the only real benefit I see to all these regulatory actions at this point is that it might make for an exciting election season if they put the economy in a ditch right before a major election. But with that now, finally, it's time to move on to the Forecast Friday metrics. As we shift into those forecast metrics, please like, subscribe, and ring the bell to help build our channel. Appreciate that. So, looking at the first table, we still see a lot of red, but we do see some green popping up in some new areas. But consumer spending, you can see how it's still a factor there. The Baltic Dry Good Index, weekly, it's down significantly. Yeah, it was up quarterly, but annually it's still way down. The China Containerized Freight Index and sub-indexes there. We've had a little bit of a weekly pop in the U.S., but it's still down around the world, and it's still down quarterly. So, it is still soft. Freight waves, we continue to see a softening domestic trucking. It's still real problematic. The 10-year Treasury spread down just fractionally this last week. Quarterly, it's improved, but we're still near historical spread. Literally, we're consistent right now with what we saw before the Great Depression. So this is a very, very obvious signal, and it is starting to get to the point where the average time, I think, is is about 16 months between when the spread breaks below zero and goes negative. When that happens and the start of an actual recession begins. And it's been a consistent indicator, and this one has been harsh and extended. So we are actually moving beyond the mean or median. So durable goods the last month and quarterly, annually, it looks very good. So that's a very strong indicator. Again, more red than green, but looking good. On to panel two. Uh, we have the mortgage applications. They improved a bit. Of course, we did have a little bit of softening in rates that helped out, but it's still down massively for the year because rates have skyrocketed over the last 12 months. So that's understandable. The weekly initial claims they're continuing to climb. So we see the negatives continuing to be shown there. Going down to toward the bottom, we have the consumer confidence index. We actually saw a little bit of improvement on this month's reading. So overall, it is up slightly. Of course, a lot of softening of that inflation really has helped the consumer index. Uh, Again, the leading economic indicator index from the conference board, which is something that I very, very put a lot of faith in. I really trust. You can see it's negative annually, quarterly, and even a little bit of monthly movement there. So here's three new metrics I've added. So we have the Chicago Fed Survey of Economic Conditions, and it's showing that dramatic improvement because, of course, lessening of inflation, these other factors this year. And but it's still down quarterly and annually, so it is somewhat soft still, but has shown some recent improvement. Again, this is survey of economic conditions. It's an opinion, and opinions take time to form and morph. So this is not as leading as some, but it is within a 90-day window, usually before things really start becoming a problem. The equipment leasing and finance monthly confidence index. Of course, people lease and finance equipment, and they have an opinion about what's going on, and they have activity as such. So again, you can see it's down a bit on the annual and quarterly basis with a recent bump. Now, the Chicago Fed National Activity Index, that's a very cool one. You can see it's down nominally there on an annual basis, quarterly basis, and on a monthly basis. But there's some sub-index, and so I'm going to be showing you the graphs here that show that. And also I want to show you, the Chicago Fed Survey graph so that you can see how these things shape. Now, the Chicago Fed Survey of Economic Conditions, you can see it's a little bit volatile. It definitely moves around. So, again, the big move is not necessarily a terribly surprising thing with that. But the Chicago Fed National Activity Index, you have the general index, plus you have the different sub-indexes here that happen to cover certain segments. Now, as far as a forecast Friday, I'm just going to be including the Chicago Fed National Activity Index going forward. Unless there's something really significant in one of these sub-indexes, I will highlight that, but I will just include on the table the one active index indicator. Okay, so moving on to the third panel. We only have a few things to address here, and two of them actually there's no change. And this is something that there's been a lot of conversation in the background about with economists and such. The manufacturing trade sales data point is one that has been consistently reported for many years, and suddenly the data stopped being updated. They update the page, but they don't show any fresh data. They show data stopping a few months ago. Usually it's a 1 month lag or just shy of a month lag. And so this is very unusual. And we also have the same issue to some degree with the change in manufacturers' unfilled orders for durables. And both these are very handy. Now you can see they were starting to move down. But there's no real reason to stop reporting it that's being shared from the agencies that generate this. So it may be something where these are put in the background for a while, or we may get a sudden burst with a large update for a few months worth of data. Down towards the bottom, we have the U.S. coincident leading economic indicators. It's been showing green for a while. It's some of the arbitrary, unique front loaded, the initial of the initial indicators. And of course, a lot of that is in response to the change in inflation. So there we have our three panels. That is enough for today. This is yet another Forecast Friday that became a bit more involved than intended, but all of what I brought, it really matters this week, and it is going to be part of the conversation going forward. So by the way, as always, if you believe something is worthy of being on this list, please suggest it in the comments, and I will definitely make a point of highlighting that. All right, well, thank you again for joining us this week and continuing the journey with us. Look forward to seeing you in the next video.